Well, let's get talking now. Economic policy leaders and researchers around the world were kept busy in 2022. Of course, by high inflation, a volatile labor market, crypto crashes, and major legislations like the Inflation Reduction Act in the US. Supply chain problems were also prominent during the COVID-19 lockdowns. The perfect storm of causes, including shifts in demand, labor shortages, and structural factors. The Russia and Ukraine conflicts and the COVID-19 lockdowns in China also exacerbated issues affecting supply in certain sectors, including consumer goods, metal foods, chemicals, and commodities market. But what was the most important development in economic and monetary policy globally and locally in 2022? Let's get insights as we review major business and economic policy issues all around 2022. My guest is an economic and investment analyst, Mr. Ayoride Akinloye. It's good to see you. Compliments of the season.
Thank you very much, Tolu. It's always a pleasure to be on the show. Thank you for having me this afternoon.
Yes, like I highlighted in my introduction with the Russia and Ukraine crisis, COVID-19 still wreaking havoc like in China and some other places where we still have issues affecting, this is a pandemic affecting them. What really to you is the impact of all of these global and domestic issues around the business environment, of course, globally and domestically?
Well, definitely, 2022 was quite an eventful year in terms of political developments as well as economic developments. Talking about policy, from the fiscal and monetary side and down to how all those policies impacted on business and the investment landscape. But let's just take it first, from the geopolitics side, right? So like you mentioned earlier, the Russia-Ukraine crisis was probably the most notable, the singular notable sort of event that really altered the direction of the global economy and the financial markets this year. Heading into 2022, expectations were that, the global economy will continue to recover in line with what we saw in 2021 following the end of the COVID pandemic, even though the economic growth and expansion across businesses was going to be at a slower pace compared to last year. But by February, March, we had the disruption from the Russia-Ukraine crisis, which basically changed the landscape of things for investors and economic policymakers at large. So what we saw was, as a result of the Russia and Ukraine war, that led basically to commodity prices going up, particularly energy prices, agricultural produce, particularly fertilizers also went up, and the ripple effect of increase in energy prices across all other segments of the commodities market and the inflation basket. As a result, we saw inflation go up. Now, inflation going up basically changed the whole narrative for monetary policy. As a result, monetary policy authorities had to, sort of begin to tighten on cash flow, on monetary supply within the economy. So by tightening, we started to see interest rates go up, which impacted the fixed income market. Interest rates going up changed the landscape for industrial producers, because it meant accessing capital became more expensive because borrowers were quoting higher interest rates due to expectation that interest rates would continue to climb due to the policy changes from monetary policy authorities. And in response, fiscal, like you mentioned, the Inflation Reduction Act in the United States, is an example of fiscal policy that governments across the world had to come up with in order to cope with the inflationary pressures, because energy prices were going blowing through the roof, and it was impacting on the pockets of citizens who particularly were not enjoying improved income, on a personal consumer level. Income was not necessarily growing, to catch up with the increase in prices that we're observing across the global economy. So it was basically a case of, the year being dominated by prices. It was about what was happening to inflation, and every other thing revolved around that. And that was as a result of, the Russia-Ukraine crisis. Yes, inflation was expected to go higher this year, but the Russia-Ukraine crisis basically changed the landscape and added more firepower to the rate of increase that we saw in inflation rate in 2022. So as a result, monetary policy authorities had to start raising interest rates in order to cope with the rising inflation, and fiscal authorities had to respond, to sort of try and provide a bit of cushion for consumers. But the overall impact is the global economy is growing at a slower pace than expected. There are talks of a recession in the euro area very soon, talks of a recession or slower economic growth in the United States, and also the ripple impact on emerging markets like China and the BRICS region. Then another thing that would also be important to highlight is, towards the end of the year, we had the significant spike in COVID-19 cases in China, which led to more lockdowns, and that weighed on commodity demand and also commodity prices. So these are some of all those key developments, across different time periods during the year that shaped the economy, and it really proved to not be a very good year for the global economy as well as for the global financial markets, because both for fixed income, for equities, it was a bearish year because interest rates were going up, so bond prices were dipping, and because of the rising interest rates, investors were fleeing away from equities, and we saw equity prices come down significantly. Even the only investors that really sort of enjoyed 2022 were investors that focus mainly on the commodity market. We would have profited a lot from the crude oil price increase in the price of gold, increase in the price of aluminum and other mineral metal products and the likes. So basically, those were just the key themes around the global economy in 2022.
Ayo, very interesting stuff, I must say. Brilliant opening now to this overview. Let's now take it up from where you stopped, talking about the markets, because all of this will impact the markets. That's talking about the stock market. Even the crypto market is not left out of this, and the commodity space, which you mentioned. What are some of the impacts? It's not been all bad news. Just like Nigeria, one way or the other, the market is still standing a bit strong, maybe not very significantly positive. But what do you think has been the hit of all of this across markets?
Okay, so I think in discussing the markets, right, it's important to make a divergence between what is happening in the Nigerian financial markets, particularly for the equities market, and what is playing out on the global space, right? So for the global space, like I mentioned earlier, rising inflation forced monetary policy authorities to begin to raise interest rates, right? And because interest rates were going up, we had a lot of investors begin to fly for safety, begin to move funds into fixed income assets. And as a result of that, we saw a lot of rotation. We saw a lot of fund flows out of the global equities market. So when I'm saying the global equities market, for example, I'm speaking to the major markets like the US equities market. In Europe, we're talking about the UK, the German market, the French stock market also, those key markets, even in the Asian markets also, those key markets really saw significant sell down as a result of rising interest rates during the year. On the other hand, similarly for their fixed income assets, it was quite negative. But on the other hand, like I mentioned earlier, it was pretty positive for the commodities market. Now, breaking it down to Nigeria, for the Nigerian space, yes, interest rates rose significantly this year, particularly towards the end of Q2 and in Q3 and the early parts of Q4, because from November we've started seeing interest rates actually trend lower, particularly when we look at the last two treasury bills auctions, right? So for Nigeria, the interest rate space, we saw lots of increase in interest rates this year, but that did not necessarily translate into negative. So it didn't overwhelm the equities market all through the year, and I would explain why. So at the start of the year, interest rates in Nigeria actually started to decline, particularly in Q1. We had, lots of liquidity within the financial system. Federal government was not borrowing aggressively at the start of the year from the domestic markets because they still had access to Eurobond issuances and, the early $950 million Eurobond issuance that they did early in the year. So they didn't really have so much reliance on the domestic debt market. So the domestic debt market was robust with liquidity. There were a bit of interest rate management from the CBN, right, that also kept interest rates quite low between January and May. As a result, we saw the equities market rally significantly, particularly the consumer goods space, the oil and gas space, which benefited from higher crude oil prices. All these things were factors that helped the equities market to sort of rally in the first about, say, 4 or 5 months of the year. But by the time we were getting into the second half of the year, the end of Q2 down into Q3, we started to see interest rates go up. Why? Because the CBN started to take a tightening approach in line with what was happening in the global economy. And as a result, we saw the equities market, investors started to book profits on all the stock positions that they had earlier in the year. From there, the equities market sort of went downhill, and year-to-date return at some point was less than 1%. But over the past few weeks, we started to see interest rates actually reverse. We started to see yields in the bonds market trend low. We started to see yields in the treasury-based markets even dip significantly. We are seeing significant bullish sentiments in the fixed income market over the past, say, 6 or 7 weeks. And as a result of that, we have seen the equities market sort of rebound. And now, I think the equities market is on a 6 or 7 week bullish run now, which is quite positive and has been positive for domestic investors, basically. So when you look at it, it's been sort of mixed bag. But the domestic equities market has been much more positive compared to what has been happening in the global space. And the fixed income market has not been really stable. It's been a very volatile market this year, starting the year with declining interest rates. And then suddenly we saw a surge in interest rates. And then now we are seeing a significant downturn, a significant reduction in interest rates. And the equities market has sort of played the line of that direction this year. And that's been how investors have had to sort of navigate their portfolios in the capital markets.
Beautiful stuff. Now, let's talk about warnings now from the International Monetary Fund and the World Banks. We've had issues from them talking about oil price, subsidy issues, how sustainable it is. They've raised the alarm over tax policies and what can be done to raise more funds, of course, one way or the other, and also interest rate issues, which you highlighted. Now, but my question really is, how seriously do you think we need to take all of these projections and reprojections that we get from these international lenders?
Well, I think yes, there's always a bit of sort of, I would say, controversy. People saying, "Oh, the IMF are just doing what favors the Western economies." In terms of, how they lend, because, a lot of African economies depend on the IMF for borrowings and things like that. But the truth is, a lot of the warnings from the IMF this year are very valid. They basically were confirming a lot of things that domestic economic policy analysts here in Nigeria, we've been saying for the past, say, roughly 4, 5, 6 years now. In fact, you can say dating back to the early 2000s, in terms of economic reforms and how the economy should be restructured to sort of maximize the potentials for the Nigerian economy. So a lot of the things that the IMF, were saying, they are actually valid, and we should take them seriously. And so, not to just talk in a generic form, let's look at some of the specific issues, right? And then see if these things are valid. Now, one of the key things that the IMF has really hammered upon this year is the debt sustainability situation in Nigeria. And it's something that is really precarious because, for example, you look at the federal government's January to August budget performance, debt to equity, debt service to revenue ratio, was at roughly about 96% thereabouts. So literally, the federal government spent all the revenue they generated from January to August on debt servicing, right? And they had to borrow even to supplement the budget in terms of to run the government, running the government's cost of governance and other recurrent expenditures, such as paying staff salaries and issues like that. So those are all issues that are valid because debt sustainability is a major concern in Nigeria right now. When you look at the government's ability to finance its debts and even the use of the proceeds of the debt, because when you break down the budget performance further, you realize that we are spending less than 40% of the total amount we borrow on capital projects, which means the debts we're actually taking, we're actually consuming them, in terms of financing recurrent expenditure, not financing projects that are regenerative in nature, such that they're able to generate revenue to be able to pay back these debts. So these are some of the issues that the IMF, have highlighted. Away from that is on the issue of fuel subsidy and the over reliance of the Nigerian economy on crude oil proceeds, right? And we've seen that play out in terms of the FX illiquidity that we've had this year. Over reliance on oil, on crude oil. If anything happens to our crude oil production and crude oil price, the Nigerian economy is in trouble in terms of export proceeds and in terms of FX and the ripple effect across the board. So all these issues, these are just, for example, 2 or 3 of the issues that IMF have highlighted this year, and they have made projections that if we don't resolve these issues over the next 12 to 24 months, we are actually edging towards, the precipice. Basically, we are likely going to the Nigerian economy, not being a prophet of doom, but we can't afford to continue to push the days of taking concrete and actionable economic policies. We cannot continue to push that backward. Otherwise, we are edging closer to the cliff, and it's going to be really not good for the Nigerian economy. So it's important for us to take these projections serious and take actionable economic policies. We've discussed some of these policies several times on this platform, around, how we can improve our fortunes in the agricultural space, how we can aid fiscal sustainability and fiscal consolidation to ensure that the federal government and all the subnationals are run on a more efficient level, and we're able to get more value out of the resources that we have within the country. We've discussed all these things several times, and even the quick wins in terms of quick economic policies that can be implemented and would really change the fortunes of the economy within just a 6-month period. So all these things are things that the federal government and key policymakers must come together and insist that must be implemented in 2023. Otherwise, over the next 12 to 24 months, the trouble that the IMF has been predicting is something that we might be edging towards.
Interesting stuff there, Ayo. Before I let you go, let's just, in 2 minutes, what's the outlook for you with all of these issues that we've identified longer discussion?
Well, in terms of outlook, so I imagine that would be across the global and domestic space. So I will start from the global space.
Yes.
In terms of the global economy, first thing is, the expectation is we would see inflation come down. We start to see inflation come down towards the end of the year. Why? Because crude oil prices have been coming down. So energy costs has actually been moderating on a month-on-month basis. Also, some of the supply chain disruptions that we witnessed in the early part of the year, we are seeing that ease gradually. And if you look at key economic indicators in terms of, particularly when you look at PMI figures for both the manufacturing and the services sector across the global economy, we are seeing improvements in that. Even when you look at key industrial hubs like Germany, for example, in the Euro area, we are seeing some of the industrial statistics sort of improve over the past month, and that is quite positive, right? But despite the fact that inflation is likely going to come down, the global economy is still very much at the risk of a recession, particularly from the Euro area. I expect that in 2023, the Euro area will likely slip into a recession because some of the major economies in the EU would slip into a recession due to, the fact that the policymakers would have to continue to tighten interest rates, which would impact on economic growth. In the US, we expect to see slow economic growth, right? Not necessarily a recession, but we are likely going to see slow economic growth below, the recent about 5-year average when you exclude the 2020 recession. Now, when you bring it down to the domestic economy for us, we think that the Nigerian economy, a lot is going to be dependent on what would happen at the 2023 election, because again, half of the year will be dominated by new policymakers, a new president, and a new ideology regarding how they're going to manage the economy. But from where I sit right now, I can say we should still continue to expect the Nigerian economy to grow. 2, we should expect inflation rates to begin to come down, even as early as December. We think inflation rates will begin to come down, but the level of decline in inflation rates, we should not expect it to be something interesting enough, right? It's not that we are going to see inflation go back to single digits or small double digits. Inflation will still be very much elevated, just that we are going to see it decline largely because of the high base impact. On the issue of fiscal policy and monetary policy, for monetary policy, we think that the CBN will likely reduce the pace of interest rate hikes. We should see cumulatively, we should see smaller interest rate hike in 2023 compared to what we saw this year. in terms of debt, we still think that the federal government, particularly, with the budget, the 2023 budget is about, I think, is about roughly almost 22 trillion that the House of Reps passed yesterday. So they are going to likely borrow, the federal government is likely going to borrow another about 11 to 15 trillion to finance that budget in 2023. So that's additional debt burden for the Nigerian economy next year and more interest to pay. So on the fiscal policy side, we are sort of worried in that regard. So these are some of the things we are looking at in the domestic economy and the global economy. I believe like time has been exhausted, so I think I won't be able to talk about the financial markets part. But I think that's from the economic policies. Investors should be able to sort of at least glean one or two ideas on how that is likely to impact on their investment portfolios next year.
Great stuff there, Mr. Yoride Akinloye is an economic and investment analyst. Thank you so much for your contributions on the program. We really do appreciate this. And obviously, our next chat will likely be in the new year. So I wish you a happy new year in advance. Thank you so much.
Thank you very much. And